I often talk with clients about how much they want to put down on the purchase of their home. And many of them say 20%, and that's wonderful. Many times I have a conversation with them and ask them if they've looked to see what their payment would be like and if they've considered a 5% down with PMI loan. I want to share with you today that comparison and let you know what it can do for your clients. My name's Miles Pitcher. I'm the owner and loan officer at Superior Lending. Here is my contact info. I first want to share with you a little bit about rates and what's happened. Today's a big day. The Federal Reserve met and they have made some announcements and changed some things in their policies. As you can see in this chart, which is an inverse chart, that is rates, as the chart moves down, rates move up. So we've had a few days of improvement and recovery, but then today the Federal Reserve spoke and we started turning the other direction. This little triangle signifies that we are locking our clients in. So we waited for the improvement and now we've got them all locked in. Here's the update from the Federal Reserve. First of all, we have been seeing this whole week a lot of whipsaw action in the stock market because of this upcoming Federal Reserve meeting. They did not give a lot of comments. The votes and the actions by the governors on the Federal Reserve Board are all unanimous. They are all on board with what's happening. So as to be expected, they are going to stop buying mortgage-backed securities by March. That was to be expected. They have said that it will soon be appropriate to raise the Fed funds rate. They have not said specifically when, but we believe the first hike will be in March. Please be aware and share with your clients that a raise in Fed fund rates does not directly correlate with mortgage rates going up. There's a tie and a correlation, but we always get clients calling saying, we heard the Fed raised rates. That doesn't mean that mortgage rates were raised. This is the news that really has made things turn to the worse, is that the Fed has been buying mortgage-backed securities and adding them into their balance sheet, into their assets. Today, they announced that and talked about that they are going to start reducing their balance sheet. They did not give a time frame, but that means that they are not, all these mortgage-backed securities that they're holding, they are now going to be liquidating and getting off their balance sheet. So it's not just we're stopping buying mortgages, we are going to then turn around at some point and start selling off the ones that we are holding. So that is not good for the bonds and for mortgage rates. It was a very middle of the road tone. They were not aggressive in what they talked about, but all in all, it was what was expected. All right, so here's the info on the 5% down versus 20% down. We're talking conventional. So first of all, what is private mortgage insurance, or PMI? Anytime you put less than 20% down, the lender is going to require you to pay for that insurance in one way, form, or another. It protects the lender. It's an insurance you get to pay for, but it really protects the lender. And it is why a lender is willing to go above an 80% loan all the way up to 95, even 97%. What decides how much the PMI cost is? It is primarily where your credit score sits, how much down payment you put down, and if there are one or two borrowers. So the higher the credit score, the lower the PMI insurance. The more down payment you put down, the better your private mortgage insurance is. So if you put 10% down instead of 5, you will have a lower PMI. On a conventional loan, is PMI permanent? No, it comes off and can come off once you've paid the loan down to where you have 20% equity. We'll talk more about that in another video. So for our scenario today, we're looking at $550 purchase price. We'll evaluate just principal, interest, and PMI. We're going to ignore taxes and insurance. We are going to assume that there is excellent debt ratios, sufficient income to qualify, and that our borrower has a credit score of 760 or higher. So let's take a look here real quick. So down payment on a 5% down loan on our scenario is $27,500, 20% is $110,000, $82,500 difference. Here's our principal and interest, a difference of $364. PMI is going to cost you $87. That's really low. Someone with great credit, 5% down, that is a low PMI amount. So you total it all together and you can see that monthly payments 2396 principal, interest, and PMI. With 20% down, monthly payments 1945. The things to consider: it $451 difference in monthly payment. That's a chunk, but also paying an extra $82,500 in down payment is a big chunk. Now take the same scenario and assume that the client doesn't have 20% readily available right now. Let's assume that it's going to take them a year to save up. So let's compare doing a 5% down loan right now or waiting a year to do 20% down. We have projections that home prices are going to move up anywhere from 6% to 12% this coming year. I picked 8%, and that's a guess. But if they move up 8%, and we do believe homes are going to move up in value, a year from now, that 550 home will cost you $594,000. It'll cost you $44,000 more. The down payment of $27,500 now, compare that against a year from now, your down payment for 20% down now has increased up to $118,000. That's $91,000 difference. We also know that rates are projected to move up. We are using a projection from Freddie Mac, Fannie Mae, 3.6% by the end of 2022. You can see now that the difference there is not so much. 2309 for now, 2160 with 20% down in the future. The difference is not that big. PMI is the same because that's now. There is no PMI with 20% down. And now look at the difference in payments. 2396, which you could lock in now for doing 5% down, versus a year from now, 2160. Which is better? You can't really say until the client's situation. Do they have 20% available right now? If they do, that's awesome. That's great. However, many clients are like, "Hey, you know what? I'll do 5% down and have some money to do some renovations on the home or buy some furniture or just keep some rainy day funds." Or to those clients that don't have the 20% down, they're like, "We're going to wait to save it up." Look at this cost of waiting. Your purchasing power is diminished as home prices continue to increase and interest rates continue to move up. So I hope this helps as you're talking with clients and looking at really what fits for them. No situation, no two situations are the same. Everybody's different and should be evaluated. That's one of the core principles here at Superior Lending is we believe every client should have options and be able to understand every single fee that's being charged. Have a good one. My name's Miles Pitcher. We'll talk to you again soon.